Hello, everyone. Today on the Final Bar, we'll talk about this market pushing onward and ever upward. The S&P up about 1.5% to just over 3,900. We'll talk about the movements in different pieces in the market today. We have energy number one today, so big recovery, nice recovery from an area of the market that certainly has been struggling in the short term with a lot of those key energy names having broken down. We'll also dig a little bit into the financial sector, some winners and some laggards. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Today on location in actually very rainy Naples, Florida. We're out of town visiting our in-laws. I'm very happy to be joining you from the Sunshine State and updating you on the markets here. The S&P having a decent day and sort of following through to the upside. I was recording a video earlier for my premium subscribers. We were talking about this balance between the long-term and medium-term weakness, which I think is very much still in play, versus short-term strength and how you deal with days like this during a bear market phase. And we'll have some thoughts as we go through it, not just in terms of price, but remember our analysis sort of hits on three components at the high level: price, breadth, and sentiment. Today, we're going to touch on all three of those. Particularly, we're going to dig into sentiment indicators, a lot of the weekly data updates Wednesday and Thursday. So it's a good day to check in on some of them. Not a ton of change, which means it's still fairly bearish positioning in terms of the positioning data we have, but also the survey data that we track. People are bullish or bearish or neutral, still overwhelmingly bearish, sort of validating the weakness that we've seen in terms of price. We have a lot of great guests on the show. I had a lot of fun with some of our recent conversations on the Final Bar. Upcoming, going on into next week, on Tuesday the 12th, we're actually going to do a special episode on ratio analysis. On this show, a lot of times we talk about ratios, looking at semiconductors versus the S&P, looking at offense versus defense. In that episode, we're going to break down a number of the key ratios that I follow and why they're so important. On Wednesday the 13th, Sam Burns from Mill Street Research in Boston. He's a great macro strategist. Maybe talk a little earnings. We'll talk a little big picture, inflation, recession. We'll see what sort of words come out in our conversation. And then on Thursday, the 14th, Carolyn Barode, an expert in Fibonacci analysis. I'm very keen to talk to Carolyn to see what price levels, what key support and resistance levels are bubbling up in her own process. Let's continue on today's show with our market recap. As I mentioned, nice update overall for stocks with the S&P, the NASDAQ moving higher. Let's dig into the details and see what sort of info we can find here. The S&P closing just above 3,900. That's up 1.5% from yesterday's close. The NASDAQ composite, a decent day, outperforming the S&P up about 2.25%. Mid caps and small caps both up as well. All of those outperform the S&P. That strength in stocks, that sort of validation of short-term strength, pushing the volatility indicator, the VIX, down just below 26. So we've talked about that range from like the 20s up into the mid to upper 30s. We're back down to the midpoint, really, of that overall range that we've been in over the last 6 to 8 months, really 2021. Interest rates pushing higher with 10-year yields back above 3%, long bond yields up to around 3.2%. Bond prices coming down, obviously, and the dollar index essentially flat from yesterday, although the trend has been overwhelmingly positive. That's put a lot of pressure on precious metals like gold and silver, which were essentially flat today for the most part. A lot of strength, though, in the energy space, with natural gas up, the UNG up about 12%, USO, crude oil ETF up about 4%, gas ETF up 6%, energy the top performing sector by far. You're seeing an acceleration to the upside in other parts, another risk asset, cryptocurrencies, arguably the best proxy we have now for pure speculation. I would argue that these assets are traded based on speculative pressures. Are people taking on risk or unwinding risk? And I think that's reflected overall in cryptocurrencies. You're seeing Bitcoin up about 5.5%, still obviously coming off of fairly low levels. We were just around 20,000 yesterday. So a lot of ground to make up to be back in any sort of overall bullish trend, but a nice bounce to the upside for Bitcoin, Ether, and the rest of the top 10 coins that we track. Let's look at the daily chart of the S&P 500, sort of check in on where things are at. And this is sort of, I think, the challenge that we're in right now. The RSI is right about at 50. It's 50.8. So it's almost dead neutral. An RSI of 50, if you know your technical indicators, this is a pretty decent measure of price momentum. So an RSI above 70, overbought or up a lot, meaning price has accelerated to the upside. The up days are unusually strong relative to normal average. If the RSI is below 30, the down days are excessively strong. It shows excess distribution. When the RSI is at 50, it's literally neutral. It's an equilibrium. It's basically saying buyers and sellers are in control. Up and down days are relatively even though you might be moving directionally. There's no real clear momentum that is taking control overall, right? You have up and down days that are essentially in balance. And that's what you've seen. If you look at the chart of the S&P over the last month, we've chopped around quite a bit. We're currently at 3,900, which is where we started about a month and a half ago, 6 weeks ago. We're at the same exact level. We're at 3,900. Now we've gone up to almost 4,200. We've gone down to just below 3,650. And here we are pretty much right back in the middle. So a lot of noise, but in the end, not a lot of directional progress. So another way you could interpret what's happened here is you had the big sell-off late March to mid-May. You then sort of hit 3,900, and now we're just sort of oscillating around that level. You can see that the RSI, again, right at 50, shows you that up and down days are pretty even. You see a bunch of big up days and a bunch of big down days all together. And in the end, what's been the directional move? Essentially nowhere. What's so interesting about this is all right around that key Fibonacci level. So you could argue that all of this trading, all of this noise, all of this volatility is still part of that testing of that first key Fibonacci support level, which was just above 3,800, on 3,815, 3,820, depending on how you would measure it. So overall, what does this mean? I think the short-term strength, again, is certainly impressive. And you're seeing some individual names. We're seeing a lot of strength. And it's located in a couple sectors. It's places like healthcare, like consumer staples, and some parts of the financial sector, as we'll learn as we go through the charts here together in a little bit. But overall, again, not enough of a materializing of demand, of buying power to really push the S&P away from this range. It almost looks like a pennant pattern or a coil pattern, lower highs, higher lows. It's not a perfect version of that because it's been kind of choppy with these gaps back here, but certainly see sort of a choppy period. So where does that net out? I would argue until proven otherwise, the trend remains lower. My market trend model is still bearish on all time frames. So I give the benefit of the doubt to the bearish side until there's enough of a rotation higher. And I guarantee the RSI would need to get above 50 for me to feel really optimistic about stocks at this point. So let's look at the sector movements today and see what happened. Energy at the top, and if you look at which stocks gained today, it's things like Apache and others in the energy sector that were part of the biggest gainers. The sector up about 3.5% today. Consumer discretionary, tech, communication services were the next three, all up over 1.5%. Those are the three sort of FANG-y sectors, if you will. Sort of the growth trade. So it was late cyclicals, energy, and then growth. What was at the bottom of the list? The defensive stuff, utilities, real estate, consumer staples, top three from the bottom, healthcare after that. So this is certainly, I would label this most likely as a counter trend move. You have, gaining the ground are the growth sectors, energy, which has certainly been beaten down so much. And again, anytime you have a sector that has moved a lot in terms of the deterioration in growth, the weakness in the FANG stocks, weakness in energy after coming off of new all-time highs up 60, 70% year to date, now down in the 30-ish% range. But still overall having a decent year, it's reasonable to expect a bit of mean reversion. I think that's how I would most likely describe or characterize what I'm seeing today. Trends are not made on one particular day. They're made on a string of days that evolve over time. Let's check in on the energy sector because this is the top sector today, but coming off some weakness. What's so fascinating to me is if you look at the chart of the XLE, and just look very simply at the 200-day moving average. Look at how often this has ended up being a pretty meaningful pullback point, right? After first getting above the 200-day moving average back at the end of 2020. So remember, the S&P at this point is making new swing highs. November is when it's accelerating to the upside, has already eclipsed the February 2020 high, and sort of all clear. Energy was a huge laggard at this point. This is when the FANG stocks were just dominating. Then you see energy sort of revert and look at the relative strength, sort of sideways there in 2021, but then re-accelerating in the fourth quarter, and 2022 has been all about energy and then everything else. But the 200-day moving average served as support back in summer of 2021, back in December of 2021, and potentially right now. So again, a bounce like this off of the 200-day moving average, I would be more amazed if that kind of thing doesn't happen. That's what you'd assume. The question is it sustainable, right? Do you get enough demand coming in, buying that weakness that you get to a new swing high? That would mean the XLE has to get to 77, 78 and get back above those swing highs from a couple weeks ago. Otherwise, this is still by definition a downtrend of lower highs and lower lows. When you look at some of those individual stocks, things we've highlighted like DVN, like FANG, even the bigger, the mega cap ones like ConocoPhillips, all of these are sort of testing their 200-day moving average, bouncing today, so sort of chopping right around that level. I think this is sort of the question mark period. I think it's too early to decide which way these will resolve. Does this end up being a meaningful bottom? And if so, I would argue that you're going to see a lot more than one day's move. It can't be ConocoPhillips up 3.5%, and that's an all clear. You need to see more accumulation. That means higher lows, higher highs, which means something like ConocoPhillips has to get above 97, 98 to get above those swing highs. So an interesting counter trend move. I would argue still a lot of weight in the market. And when we come back after the break, we'll look at some of the particularities, if that's a word, of the financial sector and look at some of those themes, but also market sentiment. We'll be back in 1 minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. This is vacation season. We appreciate you hanging with us as we juggle a lot of vacations, but overall, we're super excited to bring this content to you anytime we can. A couple quick announcements before we get to my next segment, the sector deep dive. First off, we welcome your questions. We'll do a mailbag segment on tomorrow's show on Friday. We'd love to feature one of your questions live on the air. Our email is the Final Bar at StockCharts.com. We're on Twitter at Final Bar SCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. There's such great content, so many fun conversations that I've had with some really knowledgeable market experts, expert traders, and technical analysts, all for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let's continue on today's show with our next segment, the sector deep dive. What we like to do occasionally is take a deeper look at one particular sector, talk about how it's faring in the current market, what sort of themes we can dig out. I want to talk about financials today, and I think I talked about it most recently as well. It's such an interesting sector because there's some really interesting differences in the groups, and I think it's a good one to highlight in this sort of environment. Now, when we do the sector deep dive, I usually use this function on StockCharts, which is called the Industry Summary Report. It is a really cool way of relating the big picture market environment with the 11 S&P sectors, and then the industries, the individual groups of stocks, the thematic groups that make up those sectors. To get to this, by the way, if you click on Charts and Tools in the upper left corner of our site, in the right, you have all these columns, and if you go to the Industry Summary tab, it'll show you this. Now, this is more of a chart-oriented version. I usually switch it to a table view, which allows me to start sorting columns by the scooter ranking. And then if you look, it's each sector and then the industry groups that we map to those sectors. I'm going to jump down here to financials, and I'm sorting them by their scooter ranking. So just like we do scooter rankings, which is the StockCharts technical rating, we do that for individual stocks. We do that by market cap range. We do it for a big universe of ETFs. And we also do it for non-US markets. And then finally for US industries. So we have about 106 US industry groups that we map to the 11 S&P sectors. So in order, it's all a percentile ranking. So this is ranking these sort of 12, 15 industry groups versus all the other industry groups of the other 10 S&P sectors. So what is scoring the best? Are you seeing the pattern? It's all the insurance groups, property and casualty insurance, insurance brokers, life insurance, reinsurance, all in that those top five. The banks and the things that you probably know, things like Morgan Stanley and JP Morgan and regional banks like Key and others, are all in these groups that are actually scoring pretty poorly. Now, as we go through some of these groups in particular, you'll see exactly what I mean. It's a real spread between the haves and the have-nots in this sector. Now, the way this report works is beautiful. If you click on banks, for example, it's going to give you the list of all the names. You can sort it by market caps. You can group the largest or smallest names together. You can sort it by the scooter rankings, so you can immediately zoom in on the top ranked names within the entire universe, and you can start to identify some things that are really working. You can also sort it just on what's happening today and use all these different columns to sort of slice and dice the report however you like. Let's look through a couple of these in particular, and you'll see sort of what I've been looking at here. Let's start with Credit Suisse, ticker CS. Now, this is in the banks group, as you probably know, sort of one of the big conglomerates in U.S. equities in the financial sector. This is what a lot of the banks look like right now, if not almost all of them. A clear downtrend, and however you define a downtrend, is the price is below two downward sloping moving averages. Check. We're making lower highs and lower lows. Check. The RSI is clearly in the bearish range, often getting oversold and never really getting above 60. Check. The relative strength is going consistently down and to the right. It checks all the boxes of a clearly defined downtrend. So while yesterday or the day before may have been the low for Credit Suisse, I am much happier waiting for some sign of accumulation, because during a downtrend, you will have all these little fits and starts, all these little attempts to make new swing highs. This is when someone is coming in and a group of people are coming in. Buyers are emerging, right? They're actually looking at the weakness, looking at the valuation, looking at the book value on something like a bank, and thinking, all right, this is a great time to get a bank like Credit Suisse at a huge bargain. The problem is there's not enough buying momentum. There's not enough buying power to really sustain and move to the upside. So it's just a short-term rally before the buyers are exhausted or new sellers come in and pushing the price further to the downside. I could go through a bunch of the stocks in the sector. Many of them look pretty much like this one that you're looking at right here, like CS. So I won't painfully go through all of them, but I'll just bring up a couple, and you'll see that the patterns are all different. Now, something like Key is a little further higher, right? It's not going to new 52-week lows. It's more of a new, actually, it is almost a new 52-week low in the last week or so, and they get undercut that low from last July. So, they've certainly shown some weakness, but this one in a little has only been a downtrend for maybe 6 months, while CS, it's been more about a year and a half. But you can see most of these are sort of in this pattern. I think the RSI tells a great story about the trends at work here. Look at how the momentum overall has spent most of the time below 50. That's showing you that you have way more down days and way heavier down days than any up days. That's distribution far outweighing accumulation. That is a stock overall in a negative trend. Flip that kind of chart over. What's actually working in the sector? It's the insurance companies. And we've highlighted some of these. And if you missed something like the pitch, if you missed something like our StockCharts draft back in April, all of those that I just mentioned are at stockchartstv.com. You can watch them all demand. But you'll see some of our experts over the last couple of months highlighting insurance companies like this one, PGR. Look at Allstate here in a second. A lot of the stocks in this group look like this. What's so impressive is these are charts that are going up and to the right. They're coming off of new 52-week highs or making new swing highs, while the market itself is struggling to come off of new swing lows. The relative strength has been consistently positive. Think about that relative to technology, the average hardware stock, right? Technology hardware, which is just kind of going down and to the right. Flip that over and you have Progressive with a nice consistent uptrend. In a bear market phase, I was talking with some of our producers earlier today about doing a special talking about how to navigate bear markets, how to survive bear markets. And I know if and when we do that special, and I will be contributing to it, which I most likely will, I will make the point of in any market, you want to be in stocks that are outperforming, but particularly in bear market phases. What you want to do is focus on charts where the relative strength is going up, because what that tells you, even if the price is sideways, the fact that you're not losing, which is what you're doing with most of the equity space right now, is what's so meaningful, right? 2022 has been a tough year, but for Progressive, it's actually been a pretty decent year, pushing to the upside and coming off of a new 52-week high. Allstate is one that I know in particular was featured in our StockCharts draft. While the price overall has been choppy around a little bit, again, the fact that the relative strength is so strong, that's because most of the market has been coming off. Allstate is still posting a positive 2022, still up from the end of last year, although not significantly higher. It's not too bad. And something that's holding in and able to hold the 200-day moving average while most things are below it is something that certainly could be worth your attention. I want to highlight one other group in there. There's a group in the financial sector called specialty finance. And that's a lot of what I could think of as the market data providers, index providers, data providers like MSCI, S&P Global. And they have different parts of their business, of course. That's kind of how I've mentally bucketed them. This is an interesting chart, MSCI. What's interesting about it is it stopped going down. It's not making new lows. It's actually made a stable low. So you have clear support around 380. You have highs around 440 to 450. These are the highs from late May, early June, and also from a couple of weeks ago. Sort of this consolidation pattern, right? A distribution pattern, now a consolidation or a coil pattern. Which way works? Do we break below 380 or do we break above 450? One of those things is going to happen. I would argue whichever way that breaks, that's the direction of momentum. If these break higher, it's going to be a really good opportunity to ride that next move to the upside. Take a trend line from those recent highs of the last 6 to 8 months. You'll find we're just breaking through those levels this week. Also makes me think of stocks like FDS, FactSet Systems, TRI, Thomson Reuters, kind of similar to the MSCI chart. They're actually bucketed in different groups. FactSet is within financials. Thomson Reuters, I think, is in communication services. Yeah, it's part of the publishing group, but it's Thomson Reuters is really, besides being news, it's also market data, financial analytics. And those charts are also pushing to the upside. The RSI on Thomson Reuters above 60, which could be kind of interesting if it can regain its 200-day moving average. That is our sector deep dive going into the financial sector today. Let's go to our next segment, getting sentimental. A lot of the weekly sentiment data is updated Wednesday into Thursday. And so Thursday is a really good time to check in on the sentiment indicators. So I tend to think of market analysis in 3 phases. You have price, and then breadth, and then sentiment. Price. What is the price of the market or of an asset or of an asset class or whatever you're looking at, right? What is the price telling you? Price is the most important thing. And if I had nothing else, I would look at price of the S&P, of the 10-year, whatever we're talking about. Second is breadth, which basically tells you for an index, what about all the individual stocks that comprise those indexes? Because a lot of times the individual stocks will give you a signal before the indexes themselves will. But third, and still very important, is sentiment. This is where you think about contrary opinion. What are people thinking? The price is how people are voting, and breadth as well is how people are voting with their capital. Sentiment data gets to some other subtleties. How are they? What are they saying that they think about the markets? How are people voting with their voices? A lot of times can be an interesting way to validate or invalidate what you're seeing with price. Let's start with volatility. And I was asked earlier from one of my premium members about the VIX and different regimes. What does it mean when the VIX below 20? What does it mean when the VIX is above 30? We don't have time to go through all of that, but as I've mentioned on this show before, I think of volatility in terms of volatility regimes. A static level like 25 could mean something very different in 2022 than it did in 2021. In the second half of 2021, a VIX of 25 was extreme volatility, right? That was an excessive stretch of volatility relative to the norm of the period. And often indicated a market bottom. That's kind of been blown out now. 25 is actually mid-range for the VIX in 2022, if not in the lower half of observation. So really, you're looking above 30, 35 for excessive volatility now, and 20 or below 20 as minimal volatility. So that's sort of the range. These are the shaded areas that I've highlighted here. And not that this game is ever easy, but in 2021, if you simply look at when the VIX is above 30 or the VIX is at or below 20, that pretty much lines up with all the major turning points in 2022. So keep an eye on that. If we do get further upside, if the S&P gets above 3950, kind of makes a bit of a new swing high and pushes upwards, I would be looking for the VIX to come down. You look for the VIX to get around 20. That's been some of the key peaks. And I think that is where you could see an influx of shorting or an exhaustion of buyers, some sort of combination, because the VIX getting that low means people are starting to believe in the short-term stability. The problem is it sustainable? And that's what we've not seen in 2022 thus far. Looking at survey data, we have a couple different surveys we like to talk about. The AAII survey is first. This is the American Association of Individual Investors. Not a ton of a change, although a bit of a rotation back to more bearish thinking. The bulls coming down a couple percent to 19.4%. The bears increasing a little bit from just below 50% to around 53%. So the difference between the two back up to around 33%. Again, if you look at the horizontal line, that's the current observation. So you can see visually where we're at relative to where we've been. And if you look over the last couple of months, we're really at the most significant spread of bears over bulls than we've seen going back over the last 5 years. Now, if you go back, you can see that we certainly have been a little bit wider in other bear market phases, particularly the really bombed out bear markets. I'm talking like 2009, 2002 is where you'll have more consistent bearishness and an outweighing of bears over bulls. But just look at the decline in bearish sentiment that has happened. With this reading of just below 20%, this is one of the lowest readings we've had going back for this entire series, going back for the last, or just what's on the screen over the last 5 years. It's not a minor thing that you've had such an evaporation of bullishness. This next chart is looking at the name exposure index. Money managers in the survey, what's your exposure to equities? It's just below 30%. That is excessively low. If you think of the average response, it's around 60, 70%. I think it's around 70% on this survey. I haven't looked at the data to know what the median observation is, but visually, I think that's about right, about 70 or 80%. So being down here at 30% is pretty significant, right? That shows you that there's a very much of an underweight in the equity space for money managers. If we get a further bounce, look for a bounce in that ratio, and the more that or in that reading, an increase in that survey shows you the money managers starting to put some bets back on the table. We're certainly not seeing that yet, even with the short-term strength that we're seeing here this week. Finally, the put call ratios, just very briefly, I would tell you that the way I would describe the put call ratios is at the lower end of where we've been over the last 8 weeks or so, but still very elevated relative to where we've been most of the last 2 years. After that 2020 sell-off where we had a spike in the put call ratios with very bearish positioning, we came off here and we settled back into a fairly lower end of this range. From here, we're really probably mid-range to where we've been over the last couple of years, but certainly at the higher end, just over the last we'll call it 8 or 9 months, right? You've seen a steady increase in this ratio. That basically tells you that option investors using the total ratios, that's using equity and index options, are basically being more defensively positioned. That's the reading that you see here, very, very high. So being at the lower end in the short term often coincides with a bit of a bounce in stock prices because you're getting some renewed optimism, I guess, in terms of the short-term strength that we've seen from stocks. We need to wrap the show, folks. Go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We finished our segment, getting sentimental, talking about volatility. And what I will tell you, my final thought on this is to not worry too much about absolute levels. I think a lot of times when I get questions about the VIX, it's particular levels. What does it mean when the VIX is below 20? What does it mean if the VIX gets above 35? And if I tried to tell you all you need to do is wait for the VIX to get above 30 and that's it, that might be it for now. But the problem with that is a model with limited shelf life. That's not going to work for very long because every 6 to 12 months, you get a new, what I call volatility regime. The entire range of the VIX will fluctuate. And these shaded areas illustrate the different volatility regimes that I think we've seen. Elevated volatility, second half of 2020 into early 2021, very low volatility in mid 2021, now sort of mid-range to excessive volatility now. So 20 to 30, 35 has been pretty decent so far in 2022. That's going to work until it doesn't. So focus more on where we're at now relative to recent history, as opposed to looking at some absolute level that's going to always work in all market environments. Chart number 2, we did a sector deep dive today on the financial sector, which is always interesting. I'd encourage you to use the StockCharts platform to dig deeper into different indexes, into different ETFs, and particularly into sectors and industries. There's so much to learn by looking at the individual names. On the top half of this chart, Progressive, PGR, and the insurance space. On the bottom half, CS. We talked about both of these stocks. Talk about the haves versus the have-nots. Could you do that exercise with each of the 11 S&P sectors? Some of them easier than others, particularly something like energy, where they're so homogenous and so many of them look similar. However, I found it's a really helpful way of thinking about some of the more diverse sectors like financials, like consumer discretionary, like communication services. Which charts would you color green? Which charts would you color red? Finally, the New York FANG Plus Index, a couple of charts that I talked about today in a bit of a coil pattern. I think this is an important chart to watch to see which way this resolves. Do we break above resistance on the upper hand? That would be the FANG Plus Index getting above 5,500, or do we resolve to the lower end, breaking below trendline support, getting below 4,600? Whichever way that goes, I would argue that's most likely the next leg for the stock market as a whole, because they're so geared to the strength or weakness of the FANG stocks. The RSI getting near 60, can we push above there on a rally? That could certainly indicate renewed strength in the growth space. Folks, that's a wrap for our show today. I want to thank you so much for watching us every weekday after the close. Anytime we have a show, all of our previous discussions at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.